Hi everyone, I am Eklavya Gupta, founder of Recur Club. It's a fintech platform facilitating non-dilutive growth capital for companies with predictable recurring revenues.
It is a well known fact that 90% of all startups fail. But a more interesting statistic is that only 10% of the startups fail in the first year and 80% of them fail after the first year. And one of the most common reasons is lack of funds. In this episode of the Founder Thesis podcast, your host Akshay Dutt talks to Eklavya Gupta, the co founder of Recur Club. Recur Club is on a mission to solve the problem of access to funds for startups with predictable revenue streams. Traditionally, banks and NBFCs don't lend to loss making startups, but Recur Club is able to lend to even loss making startups which have a recurring subscription revenue. Their secret sauce is in the deep tech integration that they are able to do with the borrowers, which allows them to get better data for credit scoring and get high velocity repayments. Stay tuned and subscribe to the Founder Thesis podcast on any audio streaming platform to learn about disrupting traditional business practices by making use of technology.
I just developed a great interest in both those fields. And I think that led me to do engineering from Delhi, from NSIT in Delhi. And when I went there, all the lives I had loved engineering, and then I realized, oh, it's probably finance, right? Like
That's
after 2 years Lehman crash in 2008, and that time I was in middle of my undergrad engineering days, right? That started piquing my interest in finance to understand what's happening that is shaking the entire world, etc., right? And finance is also numbers, at least at the basic level, till you go deep into it, right? Like, so really liked it from get-go, and I think that was the journey that I took. And post undergrad, actually, I joined a financial investment firm called Nomura. It was an investment bank that time.
this is a Japanese
It's a
investment bank,
Japanese
right?
investment bank. That's correct. Yes. So I joined their office in Mumbai.
Nomura, what was your role?
So at Nomura, I was working as a trader, a support role. So basically in
Okay.
the global capital markets, where I was working on structured credit transactions, working on pricing, valuations, modeling of trades that were to happen. Was primarily
Okay.
working with APAC and EMEA regions there, Europe and support primarily with a lot of traders actively to price and value their trades. Great experience, I think, because Nomura had just bought Lehman Brothers, their operations after the 2008 crisis.
Oh, I didn't know that. Nomura bought out that. Okay, interesting.
Yes, part of the business was bought by Goldman Sachs, part of the business was bought by Nomura. So the UK and the APAC region was bought by Nomura, right? Like, so whole lot of challenges after that, especially what they got into, right? A mammoth with a lot of problems. So
Yeah.
great learnings for me, right? Like, because I could see a lot of those trades that were done previously, what went wrong, how are they course correcting their ways, etc. And in 2011, 12 in Europe, there was Greece crisis. There was a lot of credit crisis in Europe that started to happen. That's been stretching since then. So pretty great experience on the structured credit side, on the capital market side where I was. I was there for 2.5 years, roughly, before I went to do my MBA.
So then you went to IMCAL, and post that, like, where did you join from campus?
So then I went to IMCAL. I did my summer internship at Bank of America, right? Like at the trading desk, coming
Okay.
from a trading experience, right? Like, so I thought, wow, that's great, right? Like, I've done the evaluation part. Now I want to be the trader. That's the best life. I did my summer internship and I didn't like it. It's very monotonous at times, right? Like, to be honest, it got to me in 2 months. It started becoming very monotonous. So I thought, I reflected back and saying that, do I want to do this for all my life, right? Like, it's a big decision. While I love finance, I love working with those things. I chose a longer term financial investment. I went to Kotak from there.
Okay.
So I joined the Kotak Alternative Investments team, where I was working with structured credit and special situations financial groups. So this was a fund structure, right? Like, this was alternative investment funds. I think great experience.
What is structured credit?
So, like, if you see about finance, right, like, there is equity, right, like that you do. There
Yeah.
is simple debt or credit, as you call it, right, like, which is a bank loan that all of us associate. But there is a middle kind of an instrument called mezzanine debt or structured debt, effectively, which structures your payment flows, right? Like, in a bank loan, they will say, I'll give you this, you give me a 10% interest rate, right? There are different ways to structure transactions. They will say, I will give you this much of moratorium. I will give you based on your cash flows. I will finance you such that you pay 10% of your shareholding or revenues or whatever, right? Some of the other fancy structures they will put to make the transaction more lucrative for both the company and the investor, right? So, and still you don't give away equity, right? And there could not be any security, right? Like in a bank loan, you would typically take collaterals, security, and other things. In structured loan, there could be. I'm not denying that there could not be. There could be some kind of security package that comes along, but that's an option that's there. It's not a mandatory thing. It gives you a lot of flexibility, basically. So I went there. I was at the desk for around 2.5, 3 years, right? Like great experience. Got a chance to work with Uday Kotak directly as well in a couple of transactions, right? Like it was a brilliant experience, I would say. Learned a lot of inherent return of capital, the philosophy that Uday Kotak follows, right? In any financial investment business, return of capital being very important as compared to return on capital, right? Especially in a credit business, it's not an equity trade. If you have given 100 rupees to someone, right, you should ensure that first those 100 rupees will come back. Then see whether you are making 15 rupees on 100 or 20 rupees on 100, right? So your return of capital is more important as a investor as compared to what returns you are generating. So he runs by that philosophy, and I think so does Kotak all across.
Right. Yeah. Kotak has not got any major exposure to all these like bank frauds and scams and big blow-ups.
They've been very selective. The culture was very different. Such a large organization, but I think still the culture was very different from some other funds and organizations that I saw alongside. And from Kotak, I moved to a company called Ivanhoe Cambridge. It's a Canadian pension fund. So they manage around $360 billion of capital globally, right, across multiple asset classes. Their APAC exposure was small but growing, right? So I was part of the APAC team when I started working with India and some of the Singapore, Australia transactions, trade experience.
So this now you're on the buy side. Kotak was like a sell side role.
Kotak was also buy side. We were the investors there.
Okay, you were representing buyers in Kotak.
We were the buyers, right? Like, so we were the funds.
And so you were giving out money. You were the ones who were lending. And who would be on the sell side? There is investment banks in the sell side also, right? Like these would be banks who represent companies that need money.
A lot of them, JP Morgan, Citi, and a lot of boutique small investment bankers running like 10 member shops running. So pretty interesting. Then I moved to CDPQ, like, so I went to Cambridge basically. So CDPQ manages $360 billion, as I was mentioning, right, of global capital. APAC was the primarily growth center, one of the major growth centers for them. India team was just starting out, right? Like, so I was heavily involved. I was the first 3 members in the India team. There was an MD, there was a senior director, and myself. It was a startup within such a big fund, right? Got an opportunity to work with who's in who of the world because there was big capital that we were managing.
They were also buying structured credit products.
It was equity plus structured credit, both. Right. Like, so even at Kotak, I started with structured credit, but then I did both structured credit and private equity transactions there. And then when I moved to CDPQ, it continued to be both again, equity plus structured credit. So different structures, right? Like an investor, I think how people have started to think in today's world is as long as you can make good returns as proportionate to the risk, right? You should be open to adopting different strategies. Right. Because the financial analysis at the core remains the same, right? What investment structure you put on top of it really determines how you want to do it and what is the best instrument to invest in, etc.
Okay, got it. Okay, so then what after CDPQ?
So I was there for around 4 years, right? Like, so great journey. I think met a lot of global folks, understood a lot of global financial investment industry. Once again, after Nomura, this was a very enriching experience. We were LPs in Blackstone, KKR's fund. So a lot of big names, $5 billion plus worth transaction is what I was involved at CDPQ alone in the whole. Then this idea came up of Recur Club that I co-founded, right? I think in one of my chats and meetings with my batchmates and a very good friend from IIM Calcutta, he's more on the product and the tech side. He was working with Gartner. And suddenly I was listening to a podcast and suddenly it struck me that a lot of these early stage SaaS companies and recurring revenue companies, right, like have access to only equity capital, right? And when I thought about my investment career, my investment experience of working with structured credit funds, and those kinds of things, I said, why is only equity available to them? Bank loan, I understand, is not available because they don't have any security, but why not any other forms of capital, right? Like where they have such strength and predictability in their revenues, just because they're burning cash because of their low scale, they don't get alternate capital, right? Like, so maybe I thought there is a big time arbitrage, right? Like big arbitrage which could be exploited, right? And hence started to delve a little deep and discussed with Abhinav, who was the other founder at Record Club, about this idea, and he resonated with the problem, right? He was working with a lot of SaaS companies, then he said that's a real problem, right? Like, because a lot of them spend on their customer acquisition, marketing, software implementation upfront. But the business model is that in subscription businesses or recurring revenue businesses, you earn on a monthly or a quarterly basis, right?
Right.
So there is an inherent time arbitrage that builds in these models. These models are great. These models are growing they've grown like 20x in the last 5-6 years, right?
So by time arbitrage, you mean that you are spending today, but you're getting the money, the return on that spend after 3 months, 6 months, whatever. So there is that cash flow has different timings, and that can be solved through a credit product.
Exactly. And this is not general working capital cycle. Like in traditional businesses, what used to happen, you sell off something and then to receive the money, there is a payment lag, right? So that is a working capital gap. But in these models, what happens is you spend the money, but even your revenue will come only after 12 months, in 12 months on a monthly basis in these business models itself. You add the working capital cycle on top of that. Working capital cycle is you generate an invoice for a revenue and then your payment is delayed, right? That is suitable for traditional businesses. For a lot of subscription businesses, you get money upfront. In fact, the working capital is not that big a problem, but I think a major problem is inherently the cash flow gap in the business models themselves, right? And these businesses are great, if you'll ask me, right? Some of these recurring revenue businesses, what it does, if you think about it, right, from a company angle, right, and from an investor angle, or from the buyer or the seller, right? So the buyer of the service is able to, or product is able to manage his cash flows well, because they pay out over a period of time.
Like this company selling the subscription is actually also selling cash flow or credit here by charging a monthly subscription instead of annual or one time.
Exactly, right? Exactly. It helps them fast track sales. B, it helps them in long term retention of customers, right? You as a company become very customer focused and customer oriented, because you have spent $100 to acquire that customer, right? You can't let him pay just $10-20 and go back. So your inherent DNA of the company changes. Then when you retain customers for a longer time, it helps you to get larger lifetime value from a customer, right? So hence, even for the seller in the long run, it is beneficial, right? And that's why you see all the companies rather these days, right? Most of them shifting towards these models. So it's a win-win for both buyers and sellers. But I think the problem for sellers is, as you said, right, like cash flow gap that gets generated because of that arbitrage. That is something that they need to solve for, basically, which was being solved through equity, by taking equity or by taking deep discounts at times, which hurts them, right? If you think about it, it reduces their valuation, which are linked to revenues these days for these companies, because they don't have any positive EBITDA, etc. We said that don't do that, guys. What if there is a platform for you? You come in, keep on charging your customers $100 on a monthly basis. Come to us, get it discounted through our platform, where you get money upfront that your customer would have paid you over the next 12 months. So whatever you would have gotten from a particular customer in the next 12 months, you get a fraction of that upfront, right? So it's basically like your customer has paid you upfront to bridge the time arbitrage. Operational revenue is funding your operational expenses, right? It matches. It is. I think it's a perfect financial sense. It's efficient capital stack management to that extent, right? And if you can do that at maybe say 10% discount, 12% discount, 14% discount, right? Which is much lower than what they were doing erstwhile. They used to give 25, 30, 35% discounts. Your Zogos of the world, Kispers of the world, even D2C subscriptions. We've seen them giving 30, 40% discounts, right? And here they're getting at a 10, 12% discount through our platform, which is great for them, right? They don't reduce their ARR, and hence they don't reduce their valuations. Still, they are able to better manage and bridge their cash flows. Couldn't have asked for better things, I would say.
Right. Interesting. So how did you get this off the ground? Is this a regulated space? Like, do you need to be an NBFC to offer credit in this format? Or like, tell me about that.
So we don't offer credit. We are a tech platform, right? Like that is facilitating these kinds of financing, right? See, there are multiple banks, multiple NBFCs, multiple credit funds, multiple hedge funds who want to explore new opportunities, right? Which are safe, generate attractive risk-adjusted returns. So there is no point going and becoming one of another finances, right? We want to leverage technology where we source these transactions, where we underwrite these transactions, and where we service these transactions, right? On behalf of particular lenders or investors that are there on the platform, right?
Okay.
So we smoothen and fasten the process right? Like whatever was being done in 20 days gets done in 5 days, right? Because all information flow is there, and hence we don't need a license, right? Like to answer your question.
Okay, so essentially, you're like an aggregator plus digitizing the workflow of making this lending happen.
Yes, faster and more intelligent way, right? Like because traditional financial institutions, right, like were not investing in this asset class. This is completely new type of companies. So to underwrite them, you need a very different lens. To create the tech-based underwriting models and rating models, that's our core, which helps investors understand what kind of risk return and unlocking them for them in an easy manner, and simultaneously companies get access to them.
What is the way in which you do that underwriting? Like that is like the core value proposition of Recur Club is that underwriting intelligence which you provide to the lenders, which would make them comfortable to actually lend money. I mean, essentially, this is like a supply-led challenge, right? Like you need to build supply first. Demand will come because it's very compelling. I mean, any company with a subscription product would want to opt for this, but building the supply would be more challenging. So, what did you build to enable supply?
Product suits so well. It helps companies save equity and time. Those two things are the most precious things that any founder would have. If you go for a VC round, it takes at least 9 to 12 months, right? If not more, end to end, right? Like because first you'll prepare for it, you'll create pitch decks, then you'll reach out to particular investors. Then some of them will reward, some of them will not reward. We'll do hundreds of meetings. Something will try and materialize, then you will try and close with some few of them. Term sheets will get closed, then DD and documentation starts. It's a long process. It's a very long process, cumbersome process, and there's very limited access as well, right? And what with us, companies can use the tech platform and get cash in bank within 48 hours at times. So we integrate with companies' invoicing software, financial software, right? Financial management software like Tally,
Like
Zoho,
Tally,
QuickBooks, then banking data, the company's bank statements or the net banking and other banking data that we get integrate with.
like just to zoom in a bit on what is the invoicing software that a company uses for recurring invoices?
A lot of them, right? Like Zoho is used a lot in India.
Okay.
Like Zero is used a lot in Singapore. So every state, every country has different versions. In India, people still use Tally a lot for invoicing. So,
Tally works for this kind of a use case also, like to automate recurring, or they do it manually.
not optimum, yes. They do a lot of it manually as well. But I think it's also driven by who's doing it, right? Like people should be comfortable using that software. And a lot of CAs and financial advisors have been as well using Tally, right? Like so, and hence their comfort. Maybe if it's not the best, but
And Tally offers like a API integration. Like as a Tally user, I can give you an API key which will allow you to integrate and get data.
yeah, Tally is a little different because there is Tally Cloud and some of the tallies are on premise.
The legacy Tally.
Yeah, the legacy Tally, you have to install a software on premise effectively, right? So the Tally Cloud you can integrate, but the on premise Tally also you can integrate, but there is a little extra effort other than just providing the username password if it's on cloud, right? Like there are certain additional keys and etc. or the user IDs that needs to be entered in for us to access.
So, and bank statement would be manual because I guess when you started that account aggregator framework was not there, right?
Yeah, account aggregator framework wasn't there. Account aggregator still in India needs a lot of improvement. For personal banking, it is great. For corporate banking, it is not the best, right? Like for anyone who has multiple signatories, etc., that system doesn't work that well right now. I'm sure there are people working on it and hope that happens very quickly.
So just for a quick 101 for our listeners. So account aggregator for individual works in this way where as an individual, I can authorize a financial institution, like say I'm taking a loan from Kotak, then I can authorize Kotak to look at my HDFC Bank data and I can revoke that authorization at a future date. So this for individuals, you're saying is pretty smooth, but for corporates, this is not the case.
Yeah, for corporates, because a lot of times there are multiple authorized signatories, and I think that is where the system fails right now. So there needs to be improvement for that. The system hasn't been developed to that level currently, but there are different ways, right? Like you can get access to the net banking, get banking data, so things like that. So there are different ways, not as efficient as account aggregation would be once it's implemented fully, but it's not that bad, to be honest.
How do you treat all this raw data which you're getting? So you're getting accounting data, all transactions happening, be it payroll, be it invoices, income, expenses, all of that. And you're also able to verify it through the bank details, like the bank transactions. What do you do with this raw data? How do you crunch it and What?
So I think those are
What
the financial
does
models
it?
that we have made. We have two, three different models that we take into account.
Hmm.
We score the company as well as score the customers of the companies, right? Because we need to see
Okay.
the recurring nature of their predictability of their revenues and other things, right? So that is very important for us as a business to evaluate.
How do you score the customers? I mean, you pull up their CIBIL score?
So there are
Like,
multiple ways. I think that's the core that we have built in. We haven't kept it very simple.
like you would pull their financial statement from MCA or something like that.
Things like that at times. Plus, we see their payment behavior, the size of the customers, the vintage of the customers, the recurring nature of those customers.
So, how many scores are generated for? Like, you might be generating multiple scorecards for each customer. Like,
Eventually, as an output, there will be one rating per customer,
hmm,
right? Like, so there will be one company level rating, and for every
hmm,
company, depending on whoever customer they have, there will be
hmm,
different customer level rating. Suppose there is a SaaS company, right? So SaaS
hmm,
company could have a double A rating, like a rating,
hmm,
and people customers out there could have triple A, double A, double B, etc. Hence, their revenues of double A are also a mix of or an aggregation of all of those. Plus, we also go on and see their financial expenses and other cost metrics as well, right? Like because while we finance predictable recurring revenues, but the
hmm,
company should be able to run their company as well, right? Like it's not that they
hmm,
need to pay only money to us, right? Like so they need to manage their liquidity, etc. So all of that also comes into account. What are their gross EBITDA margins, receivable
hmm,
cycle, growth rates, things like that, basic financial analysis that we
hmm,
do. Then we
hmm,
do a lot of alternative data fetching as well at times, right? Like we scrape alternative data sources like LinkedIn, as
hmm.
MCA, PhD.
So there'd be like a culture rating based on LinkedIn Glassdoor reviews and all. There would be rating of customers of that company, which could get aggregated to a single score. And then there would be a rating on repayment ability in terms of can they afford to pay that out and still meet their expenses. And then there would be a predictability, like how predictable have the cash flows been, like, or maybe the churn. I guess that would also factor in, like you would be looking at.
Yes, the churn is also an important factor, very important factor. One of the key factors, rather, right? Like, so the growth rate, the gross margin, and the churn rates are very important, right? Like in any business to that extent, especially in recurring models, recurring revenue models, which becomes the core. Plus a lot of other things, right? Like PF details for employees, a lot of civil legal cases, if there are
Okay.
such things or not, that people their civil score, multiple things that come out, right? Like so it's a quite comprehensive model considering their financial metrics, their operational metrics, their compliance, legal metrics, plus their track record or the past performance, plus the cultural or the softer angle, the employees and other things.
Tell me about the first deal you did. Which company was it? How many days did it take you to build this kind of a report? And how is that report compared to the report we generate today? And who was the funder for that first deal you did?
Obviously, it has drastically changed since then, right? I think this was last August when we launched to do end-to-end analysis. So the first transaction that we evaluated, that is very interesting, I would say, right? Like all that data is coming in. We because we were parallelly building our financial models, putting in some ad hoc. I think it took us at least 25, 30 days to do that. To look at it and reject it, right? Just as an open manner, because you have to go and check
Right.
each and everything manually, right? So it was a media tech company basically, right? Like based out of Delhi. They had around $3.5 million of ARR, growing very well. It was venture capital backed. There was a lot more comfort in terms of their financial positions and an institution backed them, etc. Right. So it took us 22 days, but I think what the founder said, right, like after we financed them, that your model is truly amazing because he was looking for equity as well at that point in time, right? And he realized that if we can give them $1 million, right? Like for example, we did not at that point in time. It was a small 100K $100,000 transaction. But if we could give them like $1 million as we scale, right? Like based on their business currently on $3.5 million, they would love it, right? They don't want to dilute equity at all at this stage, right? Like maybe when they go to a $10 million is what when they think about diluting equity. And it came from them that I am using my operational revenue for spending in my operational expenses. And hence I always use that line till date because it's come from the first customer who really understood and valued, showed a lot of patience as well, right? With us, to be honest. Our processes were broken.
Yeah.
Things were broken. So they obviously we didn't charge them anything, us our fees, we didn't charge them anything naturally. And that
Okay.
it was building that out. But I think it was a great experience. And I think since then, right, like that company has grown from $3.2 million ARR to what around 50 crores, so around $7.5 million. So in the last 12, 13 months, they've grown 120% almost in their ARR without diluting, right? Like they have raised an equity round now at reaching 7.5 million because they wanted around $15 million capital, right? So they took 10, 12 million dollars of equity and $2, $3 million from us. Well, our solution perfectly complements equity. For certain companies, we are not replacing equity. I think that is very important to understand and see because say if your ARR is in this example $7 million, max our models can fund you with $3.5 million, 50% of your ARR.
Which also seems very high because for a company to like give out half of its earning each month to pay back the loan would be pretty difficult.
100%, 100%, and hence it depends on the financial metrics, etc. So theoretically, it can be 50%, but it depends on your financial metrics, right? I'm saying best case we can give like a $3.5 million to a company, right? Like to a gold mine company that we have, for example, right? But companies may need more cash for their current expansion. They are entering a new geography. They are entering a new product. They're creating a new product. They need to spend much more today. So hence, and which will always happen with a lot of high growth companies, right? So we say complement equity with our kind of capital. Use equity to enter into new geographies, to start a new product, to do more R&D, where the actual payback period is long or the outcome is uncertain. But where you know your outcomes are certain, you need to spend X rupees on your distribution channels and you generate Y rupees from them, right? Like using equity is foolhardy, right? Like you should not. Large companies also complement equity with multiple forms of capital, right? Like so, if that is being made available to you, companies should use it. No, it's a no-brainer, I would say, for companies. And I think companies are realizing that the advantages they get of doing it. I'll take a simple example, right? Company today does their equity rounds, dilute 20, 25 odd percent, realizes that they are 5% in shareholding after 4, 5 rounds. Let's say they become a unicorn. 2, 3% in every round. I'm just saying, right? And they delay their dilution. If they were doing a round every 2 years, they do every 3 years, right? A, they save one round over next 10 years, right? Like, or two rounds maybe. And B, they save percentage dilution in every round. So they are broadly saving 15 odd percent of equity, 15 to 20% equity. All right. The company has still become a unicorn. And it's the founders, shareholder, the net worth that they save. So 150 to $200 million of initial shareholders, founders, net worth that has been saved because of this. The company has still reached where it had to. There is venture debt, or there used to be venture debt.
What is the difference? What is venture debt? Just help our listeners understand the various types of debt available to a startup. Like if you could talk about that.
Sure. So I think obviously equity I'll not own because equity is the most common form. Then came in venture debt typically, which was accessible to companies who have raised equity capital, right?
Okay.
How venture debt works is they will charge you a fixed coupon, plus they will charge
What
you.
do you mean by coupon here?
So they will charge you a fixed rate of interest, let's say for simplicity, right? If they give you 100 rupees and they charge you 50% rate of interest, they will say, give me 15 rupees, right? Basically. Plus, they will say that 10 to 15% of my investment, which is 10 to 15% of 100, that's a 12 and a half, right? So 12.5% of 100, which is 12 and a half, give me as equity shares, which are called warrants. So basically, what is happening is they are saying, I pay you 100, right? Let's assume it's a 1 year transaction for simplicity's sake, right? You pay me 115 back in 1 year, so 15%. Plus, you give me equity worth 12 and a half rupees.
Oh, that's over and above.
Those are the kind of returns that you end up paying. There was no option, right? There was no option to companies. And this is only accessible to companies who had raised equity, right? This is not available to every company.
Because the valuation discovery has happened if you've raised equity.
Exactly, right?
So venture debt has no use case if revenue-based financing is fairly prevalent and easy to access.
You tell me why, if you know your company is doing well, decently well, no good company would want to take venture debt. And investors don't want to fund bad companies. So there would be no transactions, right? Basically, if you think about it.
Right. Okay. Did you need funds initially? Because initially you were doing it all manually, right? You may not have needed.
Not that much, just to build the product parallelly. We wanted some capital. So we had bootstrapped, we had put in me and co-founder of Enough, had put in some money in the business to grow it, to build the minimum viable product, right? The MVP that we call, right? To get it up to a particular level in the first 3, 4 months. And by August, we were able to do the first transaction. The beauty was we did the first transaction also through the product. A lot of people do it offline and we feel good about it. And I think thanks to Abhinav comes from that bent of mind, totally different directions from where I think, right? Like, so it's perfect complementary. and skill set that we bring. And we were able to do the first transaction with a proper investor on board, with the company, SaaS company that we wanted, detailed financial analysis.
How did you source the lending partners? Like through like cold calling and using your network and all?
So my network, so I had worked in a lot of like the investment industry.
Yeah,
So it,
yeah.
right, like, so I think I know them firsthand. I just called them up. I called 50 of them. 12 of them showed interest, for example, right? Like, and two of them started business. So that's how it works. And people have realized, people have gotten good returns as well, right? Like it's
Right.
because we are not making significant returns on this transaction because we want to build this as an asset class first, right? Follow as we scale. It's been, I think, pretty good that way.
And how did you source deals?
I think deals was more of cold calling, LinkedIn, more outbound sales initially, right?
Right. And you essentially target SaaS companies because like recurring revenue to me equals SaaS. Is there anything else besides SaaS?
So SaaS is obviously a great business, right? Like an obvious choice for recurring revenue, but I think there are a lot of other recurring revenue businesses. Like, what is recurring revenue? I think very important to understand something that is predictable and has low churn in their payment behavior because you are predicting a behavior trend right here. So, which is what subscription businesses do. That you see a behavioral trend that someone is paying month over month, and hence stickiness, and hence solid financial sense, right?
EdTech also, I guess, because like Byju's has monthly installments.
Yes, monthly payments, right? Like a lot of logistics tech platforms, if you think, right, which get their
Okay.
businesses from Amazons of the
Right.
world, Flipkarts of the world, right? Month over month, they do.
So, like coming back to the product now, like you told me, first deal took about 20-25 days. And so, how is it evolved to today? Like today, how much time does it take? And how much richer is your data insights that you derive out of it, which you present to the investor? What does the investor see? Does he get like a detailed report or does he get a single score? Or like, tell me a bit about the product part.
So I think quickest that we have financed is 3 days end to end a
Okay.
company, right? Like I think we give them the limits within couple of hours of them syncing the data, right?
For the startup, there would be like a guided journey with a wizard telling them, okay, now integrate with Tally. This is how you do it, and so on.
100%, 100%, right? Plus, there is obviously we are at an early stage, so there is one manual customer support as well to help them. But we have done it all through with one operations team person, right? Like till date, because we don't want to create manual interventions, manual things.
Right.
We want to keep it as automated as possible. And then there is certain KYC documents that most of the companies would have ready. They submit that, and then you get the money basically. So I think that
Does it like then appear for all the buyers that this opportunity is available?
once we create that customer profile, right, like which is proprietary to us, there is a base profile that is shown to different, institutional investors on the platform, and there are certain strategies within which they want to lend and invest in. It is shown to relevant investors on the platform, and then they bid for it, right? All of them get their best price. So that's why it is an exchange that I called. Everyone gives their best price, and the company on the other side only sees the best price.
And the price here would be the interest rate,
Price here is the discount,
or what is? Okay.
right? When you talk about like $100 every month, right? They were giving 25% discount to get $900. Here, someone could say 10% discount, so 90 cents to a dollar, or 91 cents to a dollar, or 89 cents to a dollar, right? Basically. So if I'm saying 90 cents to a dollar, that means I'm paying 90% into 1200, which is 1080 today, right? And the balance 1200, which is 100 rupees every month, is passed on to the investor on a monthly basis.
What parameters do investors see which would cause them to give a better pricing? Like they would see one would be like a centralized collated score, like a record score. Yeah.
One is a record score that they see naturally, right? Second is their payment history, the collection, their payment track record on the Reka platform, things like that. C is their growth rates, the other financial metrics after they have financed, what has been the performance. So the company has so many bids at an average price of this, then you choose, right? Or the best price currently is 90 cents. You want this deal, pay higher.
Yeah. Right.
Within a particular window, right? Like, so it's basically a live auction that's been created for the investors.
Okay. And I'm guessing this would also be done with like a client success manager because I'm sure a lot of these NBFCs would not be in the habit of regularly logging in to check what deals are on and all.
100%, right? Like, so there are automated systems that's done not only through a client success manager, but there are automated systems that's been done There are notifications that go to them, etc. But there is assistance required, right? Like those guys are, obviously we are a very small portion of their entire businesses for large institutions. So we need to take that into account and be practical and not expect them to do whatever we want them to do, right? Like at least as of now.
And how does the money flow? Is it flows through you, or it goes directly to the startup? Or
We have created like a payment infrastructure, right, which facilitates that payment, but it doesn't hit to us, right? It goes directly from the investor to the company, basically. But it is facilitated by us.
how do you collect the payment? Like that would be through a NACH, NACH mandate.
And NACH mandates, or there are payment gateway splits, or certain things at times.
The repayment is a fixed amount or a percentage of revenue. Like if I borrow $1,000 and or let's say I borrow $900, I got a 90 cents to the dollar rate, and I borrow $900, and I'm supposed to repay then fixed $100 every month, or is it a percentage of my revenue every month?
It's a fixed number because you are financing your customers' cash flows upfront at a discount. And hence, what it does is you are not penalized for your growth. If you pay a percentage of revenue, and if you're a fast growing company, imagine you're paying equivalent to your growth rate as your KPR, which is very high. So this lets the growth be with the companies.
Got it. Okay. And what is your fees? How do you earn?
So we charge a small percentage of fee, right? Like from both sides, from the investor and the company for the transaction. That percentage varies from transaction volumes and values and things like that.
What do you earn? Like maybe what will you earn this year? What do you estimate your this year revenue will be like? Or
So it's growing very fast. I think, so I can give you high level numbers that we have around 1,000 plus companies registering with us currently in the last 12 months. We have financed close to around 250 companies via the platform. These companies have a cumulative annual recurring revenue of around $450 million, which was listed on the platform. Our financing limits on average were around 50%. So around 70 million dollars is what we have financed through the platform, and a small percentage fees, right? Like a couple of percentage points, just to give you my order of magnitude. That is where we are. We're very fortunate to get great supply side partners right early on in our journey.
who are your supply side partners?
A lot of them, like Aditya Birla Finance, Integrated Group Capital, a couple of other smaller NBFCs. There are 3-4 family offices that we work with. So there are a lot of different channels to that. Wanting to add more and more, right? Like more liquidity gets better pricing for companies. It's a win-win for parties, right? Like, so that's the proposition. We act as a financial advisor to them at multiple places. You should not misprice risk. I think that's the biggest learning that I've seen even in my past experiences, because these are cycles, right? These are macro cycles. Some of them are up cycle, down cycle. In down cycle, this hurts badly. That hurts really badly if you misprice risk in the right time. So, yeah.
This year, how much do you think you'll disburse?
So we have deployed close to around $60 million this year till date. I think we'll be close to around $85 million by end of the year.
And your earning would be about 2-3% of the dispersed amount.
Ballpark, a little lower than that. It's not that high. Like it will be a little lower than that, yeah.
But you don't have significant costs to it, because you don't need a big team here. Because this is purely tech first kind of a product, so you can run with a very lean team. And
once we run get our GTM in motion, to be honest, right? Like I think that is where some of our cost is employee cost, right? We are a tech business. 80% of our cost is employee cost. Our 60% of the team is product and tech. Right? We are a 50-member team. 26, 27 people are product and tech. Right, like almost 55% of the team. We have 2 people in operations, as I said, right? Like, so it's a very lean team on that side. And as we sort out our GTM more and more, right? Like we will not need too many hands on ground to scale this up. And that's the beauty.
So I'm curious about this. Most other revenue-based finance companies have raised a lot of money, like $20 to $50 million range. Why is that? And you have raised, I think, 2 million so far equity.
Yeah. So I think a lot of that is a mix of equity and debt. And a lot of people initially did a lot of financing from their equity because they were not able to build that supply side at times, or they thought it's a asset class at times, right? So they did a lot of financing through their own equity.
But in your case, I'm guessing you don't need to, because it's a high margin business. You don't really need to burn money to get customers. Like there's no customer acquisition cost as such. And
it's very low. There is to some extent, obviously, but it's significantly low. So our margins and our cash profits are quite good. from that point. And after a point in time, I think that everything goes well. I think business would be self-sustainable. But obviously, we plan to add multiple product lines as well as we grow, right? This is just one stream of product that we have. There are thoughts in place to be like a true one-stack financial suite for the companies, right? Like rather than just being financing, add a lot of other value add features to the companies.
Like what's on the roadmap?
Like like financial insights, helping them manage their financial statements, MISs, etc. Give them primary benchmarking across multiple companies that we see, which can be actionable insights for them, right?
What does that mean? What kind of benchmarking would this be?
So their financial metrics, so
Like their margin compared to margin of
other companies in that range, that sector, in that size range, and things like that. All of that coming into the picture.
Okay. This is a way to ensure stickiness. Like they don't come to you just for that one time transaction when they need funds. But since you're giving them financial insights, they would have a reason to engage on a more regular basis.
Yes, that's correct. That's absolutely correct. Plus, it's like a bank, right? Like you go to a bank, you get 100 things, right? Like you don't need to go to 200 places. I think that's the philosophy with which we'll build this up as we scale.
So you want to launch a credit card also?
Let's see. Way too early, right? Like while it sounds pretty good, I'll keep on discussing with my team as well. But every small product has its own nuances, right? Like so we don't want to overdo ourselves as well. We're also a very young company, right? Like so we need to time it right rather than getting into everything at the same time. But if things go well, then why not? Right? Like that's a value add addition that one can get into. And we'll probably do it through multiple partnerships, right?
A lot of subscription businesses took a big hit when the RBI regulation on recurring payments through credit cards was implemented, and a lot of recurring payments failed. And did you observe those kind of trends with your customers? Like tell me some of those mega trends which you might have observed because you work with so many companies in subscription business.
So yeah, I think that was more D2C driven. There were smaller credit card payments, more on auto mode. It was more D2C business there where any we were not working. So our business were not affected. But I think a lot of D2C subscription businesses saw a lot of challenges, right? Credit card payments stopped.
So a D2C subscription business would be like say like a entertainment
OTT platform, like an OTT platform, right? But I think that's catching up. It's catching up for sure. I've seen a lot of people saying ki venture rate is 15%. Yeah, that is so cheap, 14%. But they miss that Warren's part, to be honest. Right? Like, smartest and the smartest people will just say, so what? Like, then do equity only. If that's the thing, then do equity only, right? Like we are saying, so what? Why do they do equity?